The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. Sorry for the delay. It's now a little bit past noon here, and welcome to the 12 Points April version of our Secure Act webinar. Really glad that you can join us today. My name is Christopher Cahill. I'm a principal and partner at the firm in charge of the Family Office Services Group. Today, we are going to be chatting about the impact and changes that came about at the end of last year with regard to what's called the Secure Act. So this was a major piece of legislation, and it got the attention of virtually everyone in the retirement community and the financial planning community, many attorneys as well that do estate planning, and certainly we felt as though it was going to be an important component of the year ahead. And then in came coronavirus and COVID-19, and that blew up that whole plan. So we're now back on track and wanted to bring this to your attention and make sure that you're all aware of it. So hopefully you're able to see my screen well here. So this is me, Christopher Cahill. As I said, I'm an attorney, certified financial planner, and a chartered advisor in philanthropy. And I'm pleased to be spending this time with you today. Thank you for spending your time with me. We're going to talk about a couple of things here. The overview of the Secure Act, changes affecting employers, and changes affecting individuals and their families. Let me see if I can put this on slideshow. Be a little bit bigger for you. Hopefully you can see that. So, as I said, the overview, and now we're going to move forward and look at the employer impact. So, SECURE is an acronym that stands for Setting Every Community Up for Retirement Enhancement, signed into law by President Trump on December 20th, 2019. And this was billed as something that was going to be wildly popular for small business owners, and I believe it will be over time. But as we know, most of the small business owners today are just struggling to stay alive. But to the extent that they're able to pop out the other side of this and open up for business and continue to do business, there's some really important information in here and changes for them. So it is the most significant retirement reform legislation to pass in over a decade. The budget bill calls for about $1.7 trillion in spending. That's a lot of money. Most of those costs are being paid for by accelerating distribution out of retirement accounts, distributions out of retirement accounts, and taxing those distributions sooner rather than they would have been before. We'll talk about that going forward, but certainly this is a major impact on both retirement planning strategies for business owners and businesses and for retirees as well. So the Secure Act opens up new opportunities for retirement savers. It also limits some opportunities that many of you have counted on for decades, and certainly those of us in the estate and trust world have really relied upon this strategy called the Stretch IRA that we'll get into later in the presentation. That has been largely destroyed and is a serious disadvantage to savers and people trying to maximize legacies. So we're going to make sure that you are taking advantage of all your planning options. And as we continue forward here, we're going to see the real benefits to small businesses is an increased tax credit on starting new 401ks that's increased from $500 a year to $5,000 a year for a period of 3 years. So that increase is a benefit, obviously. There's also a new tax credit of up to $500 a year to employers who start 401k plans that include automatic enrollment. That's basically a program whereby employees are automatically enrolled in the 401k. They don't have to take action to do so. And in order to actually stop being enrolled, they'd have to opt out. So there's a lot of studies out there that focus on the fact that being auto-enrolled really makes for a more robust 401k. obviously better saving outcomes for the employees. So this new maximum eligible tax credit is $16,500 in total for over 3 years, which is meaningful to a small business. It's also introduced what's called pooled employer plans, also known as multiple employer plans or MEPs, that allow small employers that are not connected together to join into one overall 401k plan. That's going to be effective at the end of this year. It will certainly allow for economies of scale, lower costs to smaller plans, allowing people from disparate companies to join together and have one plan rather than multiple is obviously a good thing, something that we're really in favor of here at 12 Points, and we'll be talking to you more about that as we go forward through this year with other webinars and content. It's really not clear to us, though, at the moment where those cost savings will accrue. Will they accrue to the company or to the participants? Our hope is that they'll flow through to the participants. We just don't know at the moment, but we certainly are doing our best to make sure that we are seeing that. So let's see, I'm getting a question here from someone. Bear with me for a moment. Okay, I'm getting, bear with me. Trying to get this to be full screen for you. Can't do that. I apologize. Let's see, I have it over on this screen here. I'm going to simply leave that for fear of stopping it altogether. So we're going to leave it with this view. Hopefully you can all see these slides. If not, it'll be posted to our website and you'll be able to watch this back at your leisure. So making sure that we come back here. Advanced a little too far. Okay, sure. So pooled employer plans, that's obviously going to be a big deal. That'll be coming at the end of the year, as I said. Now, some of the employees are going to benefit from the Secure Act as well, certainly. One thing that plan sponsors are going to now be able to do is offer an array of annuity options inside the 401ks, permitting employees the option to protect their investment balances and draw down those assets over time, kind of a lifetime income stream, if you will. That's certainly something that's appealing to many, many people. From our perspective, time will tell if this is good or not for participants. Historically, annuities are pretty expensive and lock in rigid withdrawal or drawdown schedules and have a corresponding lack of flexibility. So we hope that that's not a negative. It's certainly, I think, intended to be a positive. So part-time employees also have now gained access if they've worked 500 hours a year for the last 3 consecutive years into the 401k, which is a huge benefit as well. And thankfully, that's a real win, and these are obviously big improvements from the prior rules and regs. And other positive changes affecting everyone. Individuals of any age can now contribute to the IRA account, to an IRA account, a traditional IRA, as long as they have earned income. So it used to be at 70 and a half, you could no longer contribute to your IRAs. That's not the case anymore. So if you're continuing to work into age 70, 75, 80, etc., you're able to continue to contribute to a traditional IRA. The required minimum distribution, the RMD age, has increased from 70 and a half to 72, which is also a win. That's a good thing. And we now have penalty-free distributions for childbirth or adoption expenses, both real good benefits from the Secure Act. So these are all wins and good news, I would say. So now we're going to transition into the things that are not so good news. The Secure Act is, as we talked about before, extremely expensive. $1.7 trillion as estimated at the time of signing. How do they plan on paying for it? I would say that they don't, that they plan on that you're going to pay for it as retirees in the form of more taxation on the IRAs that you've accumulated in the retirement accounts coming out faster to your heirs. So we're going to talk a lot about this. The Secure Act has, in fact, killed what's called the Stretch IRA. The Stretch IRA was a strategy that was wildly popular with retirees and inheritors and estate planners like myself that really allowed folks to maximize the tax deferral. I mean, as you all know, retirement benefits are tax deferred until the distributions come out. So the name of the game is to save and defer as long as possible, and then stretch out that deferral over your lifetime, over your spouse's lifetime, and then hopefully over your children or grandchildren's lifetime. That was the traditional true Stretch IRA. It's now been I would say, neutered, and we'll talk about that just here in a moment. But it's really important for you guys to understand that no matter what you see on the statement on your IRA or 401k account, unless it's a Roth, you have a silent partner in the form of the federal government, and they're going to be there to get their pound of flesh in the form of taxes at your required minimum distribution date, and then further as your heirs inherit. So we'll be talking about that, but just know that if you had, say, $1 million in your 401k or IRA at retirement, you don't really have that amount of money. You do have to pay taxes on it, so it's probably more in the neighborhood of $700,000-ish or more, depending upon your tax rate. So as I said, we have now entered this brave new world of the death of the Stretch IRA. So the Stretch IRA was one of the most powerful planning tools that we had to transfer wealth between generations. This was a tremendous technique. And, again, as I said, it was a really huge benefit that no longer exists for most beneficiaries. And we'll talk about who can continue to stretch and who can't here. But again, the old world of, say, a husband having an IRA of $1 million at retirement and taking distributions over his lifetime, this is kind of what we would look at, $2 million IRA for this one. Let's look at this example here. If a husband had a $2 million IRA with a wife and 2 children, the old rules were he could stretch it for his life, take distributions. He would name his wife presumably as his primary beneficiary. And after her passing, she would roll that over into a spousal IRA and take distributions over her life expectancy. That remains the same. So the good news is that IRAs between spouses can continue for life expectancy. But here's where things change. So under the old rules, the wife would then be subsequently able to name the children as her beneficiaries of her spousal IRA. The remaining IRA account would then pass to the children, who could then take it out over their life expectancies, which, in many instances could be decades, would have permitted tax-deferred benefits and annual RMDs to continue through the husband's lifetime, the wife's lifetime, and the children's lifetime. That was a really, really powerful strategy, and one that made IRAs and 401ks particularly good vehicles for estate planning, to the extent that you'd avoid the tax as long as you could and let the asset grow. So this is the way it would look graphically under the old strategy: husband to wife, wife to kids, kids over their lifetime, everybody's happy. The reality now, unfortunately, is that they've put a 10-year withdrawal requirement under the majority of inheriting IRA 401k beneficiaries. So as I said, the stretch from husband to wife still exists, or wife to husband, depending upon the order. Now, unfortunately, the ability to take it out over the children's lifetime no longer exist in many instances unless there's a special needs situation. There are some exceptions, but broadly speaking, the majority of beneficiaries are going to be required to take it out over a 10-year time period. And that makes a significant impact. Why? Because they're going to take distributions over a quicker period, which means by definition, taxes will be levied faster and at a higher rate. And as a result, the federal government will get more money and the beneficiaries will likely get less. So this is that lost tax deferment that we were talking about. I wish I was technologically savvy enough to have the children be not celebrating on this slide, because I would say that they probably don't have a lot to celebrate out there from that lost tax deferral. But we'll leave that for others to play with later. So let's take a look at an example here. If you were if a 30-year-old beneficiary under the old rules would have been able to stretch those distributions over 53.3 years. That's a huge, huge benefit. So what would that mean? They would take 1/53rd of a third of the count each year, or well, in the first year, December 31st, out, and each year it would slide down 1/52nd, 1/51st, etc. So the fraction gets bigger, so the amount that you take as you age gets larger, but it starts out really small, which would allow that continued tax deferred growth during the early years, which is really important. So if a beneficiary didn't need the asset, the tax deferred growth of a stretch IRA was really, really excellent. Unfortunately, that's no longer the case. So the new rules for inherited IRAs, there's only a select group of beneficiaries that can still stretch. As I said, these are the eligible designated beneficiaries. They are minor children of a decedent, disabled persons, chronically ill individuals, people that are not more than 10 years younger than the decedent, spouses, as we spoke about, and certain trusts. So most designated beneficiaries are unfortunately going to need to take the distributions out over 10 years. Again, spouses aside, the majority of other designated beneficiaries will be getting those distributions over 10 years. Non-designated beneficiaries, things like charities, your estate, and certain trusts, still have a 5-year rule. And these things all came into being for anyone passing away after December 31st of 2019. So this is the world that we're in now. The single biggest impact, as we talked about, is the changes to post-death distributions for non-eligible designated beneficiaries, those people that are going to be forced to take it out over 10 years. What that means is that you can take it out all in the first year, you can take it out all in the 10th year, or you can take it out over that 10 years, but it does need to come out and be totally distributed by the end of the 10th year. Many trusts drafted by attorneys over the last several years, the last decades for that matter, are going to need to be reviewed. So if you're one of those families that's been relying upon a trust to be the vehicle to distribute a large IRA or 401k retirement account to your beneficiaries, now is the time to call us, to call your attorney, set up a call in a Zoom meeting, most likely now, right? To address these questions and concerns, because those trusts no longer are going to do what I think you thought they were going to do. So there's a lot to be reworked. Unfortunately, this is going to mean that you're going to need to spend some money with the attorneys to deal with that, rethink your plans in general. So what are some planning opportunities that we can use to address these questions and concerns? The obvious one here is the possibility of doing a Roth conversion. So, if an IRA owner is in a lower bracket than expected beneficiaries, doing a Roth conversion during the owner's lifetime could potentially be beneficial, right? So what that would mean is the owner would convert from a traditional IRA or 401k, as the case may be, into a Roth, recognizing the taxable income in their own on their own return, and now allowing the beneficiaries to inherit a Roth rather than a traditional IRA account. Clearly, that's a benefit under these rules, right? Inheriting Roths is really preferred at this point from a beneficiary perspective because there's no income taxes as it relates to those distributions and withdrawals. For those people that are charitably inclined, that have big IRAs, though, there could be some other good solutions for them. Certainly involve more planning. One thing that is being seriously looked at by the team here at 12 Points, and we'd love to talk with you more about this, is if this is something that resonates with you, is the possibility of using a charitable remainder trust. So what would a charitable remainder trust do? Let me just broadly describe what a CRT is, and then we'll talk about how it can play in here. So a CRT is a vehicle whereby you, as the donor, could transfer an asset to the trust and retain an income interest, or identify somebody else to retain an income interest for a period of years or for your lifetime, or their lifetime, as the case may be. And as this indicates, the remainder, so you have the income interest going to yourself or the beneficiary for a period of time, and then the remainder interest being at your passing or the passing of the named beneficiary would go to charity. So the CRT is a vehicle that allows either yourself or your beneficiaries to get an income interest for a period of time, maybe their lifetime, and the remainder to go to a named charity. So this is a really excellent strategy for many estate planning situations for folks that are philanthropically inclined, that are looking to minimize taxes and avoid possibly a big gain on a capital gain asset. So we utilize CRTs for many folks that have highly appreciated assets, whether it's a business interest that they're about to sell or some legacy stock holdings, whatever the case may be. They're really valuable. But how does it play in here? So let's go back to that example of the husband with the $2 million IRA and the wife and the 2 kids. Rather than doing the traditional strategy of leaving it to the wife and then having her leave it to the 2 children at her passing, we could do the traditional spousal rollover. So husband takes his distributions over his lifetime, wife takes hers over her lifetime, and then from there, rather than leaving it directly to the children so that they now have that 10-year distribution under the new rules, instead the wife could create a charitable remainder trust at her passing and fund this CRT with the IRA asset. So now the IRA goes into the CRT, names the 2 children as lifetime beneficiaries. So now what you've done is you've avoided that 10-year payout, and you've created a lifetime income stream to the children through the CRT. Now, of course, the rub here is that if there were an early passing on the part of one or both of the children in that example, the asset would pass to charity quickly, thereby reducing the amount of money available to the family otherwise. So that's certainly a downside. If you are inclined to be thinking about the CRT strategy, it probably would make sense to marry that with some form of a life insurance plan to make sure that there's assets to replace the asset that would be otherwise going to charity. So this is reminiscent here, as we talk about in the last bullet point, of the zero estate tax plan. An IRA is by definition an embedded tax asset. Instead of doing the CRT, if that was too complex, something that you just weren't interested in, husband could leave the IRA to wife, wife could take it over her lifetime, and then simply leave it directly to charity. Do not pass go, do not collect $200. The asset's gone. You've now zeroed out your both estate and income tax as it relates to that asset. Of course, the family's gotten the goose egg, nothing. So that may be fine. You might have other assets that are just being distributed to them that don't have the embedded tax, and that could be just perfect in your situation. Many instances, however, people do want to think about securing that legacy otherwise. Life insurance can be a wonderful solution. In the world of the Secure Act, life insurance is definitely going to become more attractive. Life insurance, as you see here, can provide cost-effective ways and efficient ways to ensure that the heirs receive a desired inheritance, whatever that may be, either in conjunction with a CRT or instead of the asset altogether, as I said, with an asset going, the IRA going directly to charity, or just as a vehicle to offset the loss of the stretch, right? If you structure insurance ownership properly in a trust, really wonderful things can happen. You can avoid income taxation, you can avoid capital gains taxation, you can avoid estate taxation, and it would help offset that tax burden that would be levied on the next generation. So really great vehicles for giving. You could, in fact, if you wanted to, lean on the IRA. The same asset that's creating the problem could be used to create the solution. You could take distributions from your IRA. Obviously, those would be taxable, and use those distributions if you didn't need them otherwise to help fund your annual insurance program. That's one strategy that many people are contemplating here, but there's a lot of others, obviously. So, you know, using life insurance as part of a coordinated estate and financial plan definitely can help you achieve your estate planning goals, leave a larger inheritance to your heirs, and have more certainty as it relates to the overall estate plan and legacy that you're planning on leaving, and can do so in a very tax-advantaged, tax-sensitive way. So this is really the big impact of the Secure Act that we wanted to go over with you today, the benefits to employers, the benefits to savers, and the detriment to inheritors, and things that we can do to fix and address. So thank you for joining us here today. I'm going to take a quick peek and see. So at the moment, I don't have any current questions. If you come up with any going forward, my contact information is right here, chris@12pointswealth.com. You can always call me as well at 508-934-9409. Happy to talk with you and talk about any of the strategies that we've discussed here today and think through any of your personal situations or family situations that you might be wrestling with. But certainly thank you for your time. We try to keep these things short, sweet, impactful. So, you know, we're now cresting over just a half hour. In the absence of any additional questions, I am going to sign off and say thank you again. All be well. We'll talk to you soon.